Good afternoon. We are going to start our the session for today. The topic is China monetary and economic transmission to Latin America. What is new? Our first speaker is going to be Alejandro Werner from the IMF. So, Alejandro, please.
Thank you very much. And let me first thank Julio and Mark for inviting me to this great conference. And I'm going to share with you a little bit the outlook for Latin America. What are we seeing, the main policy challenges? And just to address, the topic of the session, I think we have discussed in many of these meetings the links between China and Latin America going basically through trade, that obviously is the most important and direct channel, and working through commodity prices, and having those countries obviously that are producers of metals being the most exposed to swings in demand from China, and then countries that are producers of foodstuff, and after that oil demand being a little bit less influenced by movements in China, but obviously affecting Latin America as well. And obviously that's the main challenge, and also generating a division between the effects of China between South America, that is much more exposed to China through this channel, than Central America and Mexico, that basically are non-commodity exporting countries. The second link from China to Latin America, I would say, is foreign investment. We have seen in the last decade or 15 years a significant increase in investment by China into Latin America. This has been linked also to commodities, but also from the financing side, it has been linked to these countries that have had more difficult or special situations with respect to their access to international capital markets. So this is a link that has become more important for those countries that have difficulties or special situations in accessing international capital markets, and it's a very particular effect. And this, I would say, separates those countries in Latin America that have sound fundamentals, open capital markets, etc., vis-a-vis those countries that have had restrictions in the balance of payments, that have had problems with the fundamentals, and that have had significant increase in controls in their economies. And the third point that is mentioned in the title of this session is basically monetary policy issues in China affecting Latin America, and I think that will run more through exchange rate changes in China affecting Latin America. And there I see, maybe two dimensions. One is obviously the global dimensions, to the extent that significant changes in exchange rate policies generate significant volatility in international capital markets. All of Latin American countries will be affected through this channel. And then I would signal, if we think, let's say, on real devaluations of the yuan, the way I would see this playing through to Latin America is, on the one hand, to the extent that these movements in the real exchange rate in China support growth in the future, and therefore support the demand for commodities. This will be beneficial for South America. On the other hand, a depreciation of the real exchange rate in China obviously will be negative for those countries that compete with Chinese exports in third markets like Central America and Mexico, and therefore having this differential effect. But I think, discussing Latin America today only through the prism of China would not be, I think, the best thing to discuss today, given the slowdown that is taking place in the region, and that a significant part of the slowdown is much more associated to the interaction of a deteriorating external situation, but more than that, this happening especially in those countries in which fundamentals are weak, and in countries in which domestic rigidities and domestic distortions are significantly amplifying the slowdown coming, let's say, the deterioration in their exporting situation, and the deterioration in their access to international capital market. Our latest World Economic Outlook that was put out in April during the spring meetings had the world economy growing at a similar rate than last year, with the advanced countries maintaining the rate of growth that they observed last year, having a very similar year this 2016, and something very similar expected to 2017, with a slight change in forecast associating to Japan. At that time, we were expecting the VAT changes to take place next year, and that explained the slowdown that we were expecting in the Japanese economy. And again, a very similar year in 2016 for emerging markets that had significantly slowed down their pace of growth from around 7.5% a couple of years ago to 4% this year. What does this imply for Latin America? And I don't know why this should be something, I don't know how to, I mean, yeah. Okay, let's see. Okay, so if we look at Latin America, this will be the second year in a row in which Latin America experiences a negative rate of growth. Basically, this is associated, I would group the countries in two camps. One camp is a group of countries, especially in South America, that are having, let's call it a natural slowdown associated to the deterioration in the external environment, but it's more like the normal business cycle associated to a deterioration in the terms of trade. And there we can see, I mean, the case of Colombia, we can say the case of Chile, the case of Peru, et cetera, and then those countries in which domestic fundamentals and a negative external environment has combined to generate a significant recession and crisis in this economy. In this group of countries, obviously, the situation of Venezuela stands out, with being the country with the highest inflation in the world, and also being the country with, from the large economies, having the largest cumulative contraction in the last 2 years. We're expecting the economy to contract by 8% in 2016, after having contracted by around 5.5% in the previous year. Second, we have obviously the crisis in Brazil continuing. I mean, to the extent that the political crisis continued throughout 2016, we had a change, for now, let's say, a transitory change in government until the impeachment process is completed by, let's say, the next 3 months in Brazil, a significant political crisis taking place together with a very important macroeconomic adjustment that is needed, together with a changing regime in governance rules associated with corruptions and public procurement, generating another year of -3%, 3.5% growth this year. Third, we are also expecting an important recession in Argentina, associated to the adjustment that has been postponed for a significant period of time in that country, that is being implemented by the new administration, and basically generating, we think, sound conditions for a resumption of private investment-led growth in 2017. And I would highlight the fourth country that we're expecting to suffer a significant recession in 2016, that it's Ecuador. Ecuador is the second country in Latin America that is most exposed to the decline in the price of oil, and on top of that, having a dollarized system, the only adjustment variable to the shock is the fiscal adjustment that they have to do, and they don't have the escape valve that other countries in Latin America are having through the exchange rate and monetary policy, and therefore they're suffering a significant recessionary adjustment. The lack of a lender of last resort also generates a vulnerability to bank runs in this economy, and therefore a very fragile situation in the case of Ecuador. I mean, when we look at the terms of trade and trying to disentangle, I mean, where the external situation is actually leading to a significant adjustment, and where it's, the external situation has deteriorated a bit, but still it's relatively good vis-a-vis what we had at the beginning of the previous decade. I mean, obviously, in those cases that are oil exporters, such as Venezuela and Ecuador and Colombia, we have seen a very sharp decline in the commodity terms of trade in those countries. I mean, here we have the case of Ecuador and Venezuela having a very sharp loss of income associated to the decline in the price of oil. The same thing happening in the case of Colombia last year. I mean, basically, if we look at Mexico and Brazil, these countries have some changes in their terms of trade, but whatever is happening there is much more associated with domestic circumstances. When we look at the case of Chile, there has been some decline in terms of trade, but still the terms of trade are at a relatively high level. I mean, in the case of Chile, having been affected by the decline in the price of copper, but in the last 2 years also having been helped by the decline in the price in the price of oil. If we look at what has been happening to financing in Latin America, I mean, in 2015 we have seen an important decline in portfolio investment, but we still have recorded positive inflows of portfolio investment into Latin America. FDI has been holding up relatively well throughout the last 18 months. And when we look at what has happened to sovereign spreads in Latin America, obviously in every country we have seen an important increase in sovereign spreads associated to the weakening of domestic fundamentals, the increase in risk aversion that has taken place in international capital markets. And what we try to do in the chart on the right is basically decompose the increase in sovereign risk into let's say a global component and a domestic component. I mean, if we look, let's say, obviously at the cases of Venezuela, Brazil, and Colombia, there has been an important domestic component driving in the increase in spreads. Obviously, when we look at the case of Argentina, there has been a significant positive domestic component driving the decline in spreads as the new administration, I mean, design, let's say, a macro stabilization program for the next 5 years, have re-accessed international capital markets by solving the situation with the holdouts, and at the same time has removed a significant part of the controls in the balance of payment, normalizing a significant part of the excessive controls that that economy was being subject to, limiting a dynamic investment environment in Argentina. Obviously, I mean, this deteriorating external environment, together with the weaknesses in domestic fundamentals, has generated, I would say, a regional significant adjustment in exchange rates. I mean, we have seen exchange rates depreciating between, 80% for some countries, and between 30 and 40% for other countries. As I said before, a significant widening of country spreads, stocks market significantly going down, and also, I mean, the sovereign spread deterioration contaminating corporate spreads, and corporate spreads also being affected by the drop in commodity prices, the depreciation of the real exchange rate, and the weakening of their domestic markets. I mean, when we look at the components of aggregate demand, we have seen a very sharp adjustment in private investment growth throughout the region. I mean, being much deeper, obviously, in the cases of Brazil and Argentina. In Argentina, we have seen private investment showing negative rates of growth for the last 4 or 5 years. Colombia holding out relatively well vis-a-vis other economies, and now that slowdown significantly contaminating private consumption. I mean, deeply so in the cases of Argentina and Brazil, but in the rest of the economies also, I mean, exhibiting a slowdown in private consumption in the region. I mean, on country focuses, I think I cover a little bit what is going on in some of the main economies in Latin America. Maybe I would like to, in the benefit of time, I mean, highlight, let's say, in the case of Colombia, the role that the exchange rate has played as an adjustment variable to the deterioration in the price of oil. And in that sense, I would say, vis-a-vis what we expected maybe 2 years ago, what we have seen in Colombia is a shallower deceleration of GDP growth. I mean, however, we have seen a much sharper acceleration of inflation than the one we predicted, let's say, 24 months ago. And I think now the main challenge for the central bank, for the authorities, has been to contain the second round effects of the depreciation of inflation on inflation expectations, and that might trigger going forward maybe a sharper slowdown of the economy, especially if we continue to see the lack of correction of the current accounting balances that we are seeing in that country. In the case of Mexico, I would only highlight, that the decline in the price of oil has not affected growth that much. I mean, Mexico is no longer an oil exporter. When you look at the net oil balance as a percentage of GDP, this is almost zero. However, oil continues to be a very important determinant of the public accounts. This, together with some dynamics that were happening even before the decline in the price of oil, has generated a fiscal situation that that markets has caught the attentions of the market, where we see gross public debt in the case of Mexico significantly growing. Part of that is the effect of the exchange rate depreciation, but it's a trend that has its origin way before even the decline in the price of oil, and it has intensified in the last 2 or 3 years, and therefore the need for the country to significantly strengthen their public finances and stop these negative dynamics. As I mentioned before, in the case of Brazil, significant fiscal challenges. I would highlight in this chart the important change that has taken place in how people perceive fiscal sustainability in Brazil. You can see the different vintages of debt dynamics estimated from Brazil, from one in which public debt was going down from 65% of GDP to 55% in 2017, being made in 2012, to one in which, explosive debt dynamics are taking place in that country, and that being the main challenge for the authorities in Brazil in the next few years. The case of Argentina, as I said before, an economy that used to have significant current account surpluses, that after the crisis suffer a significant deterioration in macroeconomic fundamentals, generating an important external vulnerability led by a huge deterioration in the public sector accounts that trigger a significant increase in inflation, the widening of the current account deficit, the loss of international reserves given the lack of adjustment on the exchange rate, and that leaving the current government with a significant challenge of significantly correcting public finances. These are their targets for the current administration, and a significant challenge of reducing inflation in Argentina, and more than that, a structural challenge of resuming a private sector investment-led growth process, basically by dismantling all the network or cobweb of controls and a lack of reliable regulatory framework in that economy going forward, and that I think is the main challenge that the Argentinian economy is going through. I already described, the main challenges in the cases of Venezuela and Ecuador. In the case of Venezuela, basically a double-digit public sector deficit with inflation running at around 500% this year. The lack of reserves, a significant contraction in GDP, and more than the macroeconomic challenges that they face, now facing a significant humanitarian crisis associated with the shortages in food, shortages in medical supplies, etc., generating a very complicated political and social situation. In terms of Latin America as a whole, I would like to highlight three challenges with respect to public policies. On the first side, basically the challenges on the fiscal front. If we see what has happened in Latin America in the last 15 years with respect to primary government expenditures on the back of the commodity boom, these countries have ramped up government expenditure significantly. If we look at the case of Argentina, the case of Brazil, even in Chile, a small increase compared with the other countries, but significant increases. The same in the case of Colombia, obviously the case of Ecuador, doubling the size of the public sector government expenditures. In the case of Mexico, going from 17% of GDP to 25% of GDP, much smaller magnitude in the case of Peru. But at the end of the day, public finance is now in an environment of slowing growth, slowing or much lower commodity export prices, depreciating currencies, and higher financing costs. Public finances will have to start the consolidation process. Basically what we have in this chart is a fiscal adjustment needed in the medium term in each of these economies. These are the current primary deficits in each of these countries. The red line shows the debt stabilizing primary surplus in each of these countries, and therefore the difference is the needed size of the fiscal adjustment in each of these economies. Obviously, the level of debt, that is the numbers that we have here, also tell us, the space that these countries have to postpone or do a much more gradual fiscal adjustment, and those countries in which a very weak fiscal situation will need to be addressed with a significantly front-loaded fiscal adjustment. Obviously the case of Brazil stands out there. But even, in the case of Chile, having a significant fiscal space with very low gross debt and even lower net debt. However, running large primary deficits, and therefore, a gradual fiscal consolidation that is needed to reestablish, the significant strength that Chilean public finances have shown in the future. In monetary policy, this is the most, let's call it, successful exchange rate depreciation in the history of Latin America. Here we basically graph the depreciation versus the US dollar and the inflation rate in each of the episodes. The red dots are the current episodes of depreciation, the blue dots the previous episodes of depreciation, but basically showing that central banks have to manage the negative second round effects that these can have on inflation. But up to this point, we have seen the exchange rate basically playing its role of an adjustment variable very successfully. And I will just close with the growth challenge for Latin America. Basically, potential GDP growth is being revised significantly downwards. Basically showing that the very important increase that we had in capital deepening and the positive demographics that were the norm in the last 10 years will no longer be present in the future, and therefore, even assuming a significant increase in TFP growth in Latin America in the next decade, if we don't see a significant change in private sector investment or TFP growth, it will be very hard to see in Latin America a resumption of growth on average to the levels of 4% that we saw before. Thanks.
Thank you, Alejandro. And now our next speaker is Professor Felipe Larraín from Catholic University of Chile.